present case 31, which is aroma accounting scandal. Before we proceed, our group member consists of AISHAH FARIHAH, ALIA ZULAIKHA, NOOR AUFA SYAHIRAH, NOOR HANISAH, and NOOR Hanini Qistina. This is our content for our presentation for today. So next, we move to the next presenter.
Hello everyone, I am AISHAH FARIHAH binti MUTALIB. So we are going to use SWOT analysis as an appropriate analysis techniques for the identified issue. SWOT analysis is a framework used to evaluate a company's competitive position and to develop strategic planning. SWOT analysis is a strategic planning and strategic management technique that provides assessment tools and used to help a person or organization to identify strengths, weaknesses, opportunities, and also threats related to business competition or project planning. Let's move to the first one, which is strength. Strengths describe what an organization excels at and what separates it from the competition. The first strength the Aroma have is they have a good reputation. The first Aroma store opened in 1927 in the UK. It will be so easy for them to attract customers and investors because people already believe, and plus the company must already have many loyal customers since it has been established for more than 4 decades. The second one is less competition. Since their company has been established in the industry for a long time, it makes them less competitive because they are far forward than other small companies. They also have a lot of experience in handling stock and customers because they already know the ins and outs of a company. The third one is they have a wide range of products or variety of products. Aroma have expanded their company by producing various wide range of low-cost products such as toys, stationeries, electric appliances, furniture, telecommunication, and also internet services that suit the taste and needs of consumers. Therefore, their products are an essential requirement for every customer. The second analysis is weakness. Weaknesses stop an organization from performing at its optimum level. Aroma has several of weaknesses. The first weakness is poor governance. Aroma had faced poor governance due to the board of directors lack in competencies. In this case, it happened due to a lack of business understanding and skills to run the company. Therefore, they had failed to manage the business activities of Aroma. The second one is lack of expertise in the board. Aroma still lack of expert person in running their company, since there is only 2 persons who had knowledge and experience in the retail industry. Meanwhile, the 10 board members has no experience in retail industry, hence they also had different type of background. The lack of retail expert in the board's composition caused concerns about the knowledge and competency of the board when it came to the retail industry. This can cause instability in managing the retail industry. The third one is bad relationship with supplier. Aroma have a bad relationship with their supplier in late making payment. Aroma also charge a high stocking fee to suppliers for their products to be displayed in Aroma's retail store and to be placed at the strategic positions in Aroma shop shelf. This have gave a bad perception of the Aroma to the new suppliers. The third analysis is opportunity. Opportunities refer to the elements in a company's external environment that allow it to formulate and implement strategies to increase profitability. The first opportunity they have is expansion of qualified professionals in the team. According to board of directors, between 12 members in there, only 2 that have extensive retail experience. With the professional world moving at a faster pace than ever before, standing still will cause Aroma to be left behind as peers expand their knowledge and skills. Actively pursuing professional development could ensure that knowledge and skills stay relevant and up to date. If Aroma can expand and strengthen this team, the company can continuously create and seize new opportunities. The second opportunity is increasing market share and expand retail business. The other opportunity lies in the company's expansion into the emerging markets and the developing world where it has it has an untapped customer base that can be leveraged for effective profitability. Aroma is already drawing up plans to enter markets like China and India with a clear strategy of cost leadership, which it hopes will yield benefits to the company. Aroma has the opportunity to create strategic partnership with major firms or merge with the other global retailers. Acquisition of small companies can also be a profitable opportunity for Aroma. The third opportunity is rising in demand of cheaper product. In general, the lower the price of a given product or service, the greater the quantity people will be willing to buy. Buyers tend to purchase more of products the lower its price. Since Aroma offering a low-cost product, they always have an opportunity to attract a wide number of customers to purchase their product. The fourth one is create home delivery future. Pickup and home delivery services have been essential in this era. This feature could provide Aroma with the option of expanding its customers base by making the business more visible. They are also much convenient for the customer since they can place an order anytime and anywhere. Time and money should be invested into this feature so that it does not just stay as a great opportunity for a huge company such as Aroma. It can also improve upon its online store and can come up with new ways to reinvent this pickup and home delivery service. The last analysis is threats. Threats refers to factors that have the potential to harm an organization. The first threat that Aromas have been through is price wars. As a transnational company, it is vital to keep the cost low in order to increase their share in the market. However, it is exposed to various price increases, including the trade tensions. Online retailers who can provide even lower costs because they do not have a physical presence means that they are snapping at the heels of Aroma. The second one is the growth of online convenience stores. Other retailers perform better in the online space. They were proposed built to be online companies, and even with Aroma's massive reach, there are still some products that are easier to find online. Aroma's success has been and will likely continue to be built on in-person shopping, which can chip away at its potential profit if it cannot keep up with consumer demand in this way. The third one is business model being copied by its rivals. Aroma low-cost business model has been imitated and copied by its rivals, which means that the company needs to constantly innovate if it has to stay ahead of the competition. Aroma needs to come up with the newer strategies. The fourth one is regulatory threats. The business industry is gradually getting more and more regulated. On a global scale, governments and legal agencies are regulating all kinds of sectors and businesses, and the grocery and merchandise market is not an exception. This includes labor, quality, customer service, and many other aspects of industry. All of this regulation might eventually have a negative impact on Aromas. The last threat is negative press and media coverage. Negative media coverage can cause serious issues for Aroma reputation. In this digital age, it's all too easy for such coverage to gain traction and be spread at an alarming rate, popping up every time someone conducts a Google search. It has the potential to cause immediate harm to Aroma reputation.
So I will continue with the issue arise from this case study. The first one is poor corporate governance in the company. There are only 2 of the 12 board members who had vast experience in the retail industry. So, it is insufficient experts to effectively navigate the retail industry of Aroma. The other board members have no experience at all in retail, such as from bank, telecommunication industry, finance, and so on. This is because 2 of the female non-executive directors decided to resign from the board. For the alternative recommendation, government need to consider setting up internal controls. Internal controls can aid in the protection of assets, the accurate recording of transactions, and the achievement of the organization's goals and objectives. It is include compliance with legislation. Plus, Aroma itself should hire more experienced board members in the retail industry to ensure the progression in the company is effective. By having the aspect, monitoring the whole organizational will be more efficient by overseeing each progression in the department and taking swift action if any problems arise. Moreover, the experts may help in maintaining Aroma as a transnational grocery and merchandise retailer. The ethical concern here is lack of professionalism, as Aroma unable to find the experts in their retail company. We can see when there are only 2 experts, which causes problem facing by them. For example, we can see during Christmas sales and several warnings during 2015 related to the sales and profit as well. It caused dissatisfaction among shareholders. The company has poor corporate governance, as the board members in the company have lack of expertise in retail industry. It caused Aroma to broken the grocery supply code of practice, but there is no penalty imposed, as it is only applicable to large supermarket that breach the code after 5 April 2016, while Aroma was detected in December 2015. For the solution of ethics, Aroma need to increase the number of expert people to handle the company. It may be up to 8/12 from board members. This is because expert people are more efficient. They know what they do and they know how to do it. This will accelerate the time it takes to complete a vast number of tasks. Working with an expert will ensure a company is stabilized for foreseeable future. Plus, they will know what is the code that Aroma will breach in the retail industry, as they have more knowledge about it. Next, the company also can send their employees to go special training to ensure that they are doing a good job on how to deal with the ins and outs of the company. Next, for the second issue is the role of board, stakeholder and regulators in curbing or dealing with the accounting scandal problem. The board members have neglected their monitoring role to govern the company. They have failed to review and approve financial statement and financial reporting, which result in profit overstatement. On 27 October, there is overstatement of £188 million in the first 6 months of 2015 and £100 in 2014. The board members have been irresponsible in overseeing the company's management and lead to a flawed financial operation of the company. The CFO position is also vacant for up to 6 months. In this case, regulators play a vital role to protect the interests of stakeholders, ensuring that there is efficiency and integrity of the market. For the recommendation, company directors need to train employees to spot the risk of false director fraud, which occurs when a con artist pretends as a director and instructs a subordinate employee to submit important bank information. Every financial reporting should be reviewed by the accountant, ensuring the accounting principle is followed. For example, reporting framework such as MFRS, GAAP, and so on. It is important to ensure that financial fraud can be reduced, checking any abnormal transaction occur in the company, as Aroma may able to detect the problem and able to reduce the financial damage. There is unethical behavior arise from this issue, which is lack of integrity. It can be seen when there is no review and approval made from them to Aroma's financial statement and financial reporting, which lead to problem as they are unable to find out why Aroma profit is overstated. Here's the solution. The first one is address conflict honestly and respectfully, because effective leaders build trust with the people they lead. Why? Because it may provide opportunity for Aroma to grow. Plus, the communication between the employees is important to avoid any bad assumption between the employees in Aroma. Each team members should always give reminder for one another to avoid any misconduct or do not done their role in the company. So it can be proven by this case study when John Chong made public announcement in response to EY's report, stated that he was guilty for unable to oversee the operations in Aroma to safeguard the interests of Aroma. According to whistleblower Augustine in July 2015, as well, he failed to get attention of 3 board members in accounting report and end up the report is missing. The second unethical behavior arise here is financial malfeasances. It is about the management board in Aroma involved in fraud, and it may result in poor trust between the shareholder.
So, the third issue arises in Aroma, which is the relationship between Aroma and the supplier. So, normally, Aroma would purchase the product from the suppliers by credit. However, the supplier stated that Aroma often deferred the payment, which took a few years to make the payment of the owed money. This action will threaten the business relationship with the supply management. Furthermore, Aroma has also charged the supplier with higher floating fee for their goods to be featured in the store. Aroma was in a difficult financial situation at the time, however, continued to book promotional rebates based on the past volume and increased thousands of lines of new product from the supplier. We might conclude that Aroma engaged in financial statement inflating activities. So we have identified a solution in solving the issue. The first solution is to provide enhanced visibility into invoice and payment status to the supplier. The automated digital payment solution can make it easy for vendors to log in and view the status of payments and invoices in real time. Enhanced visibility also enhance the communication since the supplier benefit from full transparency. Suppliers can view which payments are incoming and enter payment account information securely into the portal. The second and the well-founded solution to the respective issue is to rebuild the relationship between Aroma and the supplier. The supplier had done their job by giving Aroma's full attention and convenience in all areas to guarantee that his demands were met. This compasses things like quality, timeliness, simplicity of access, and condition commitment. Therefore, Aroma should make the payments on schedule. Before entering into a transaction, Aroma should always negotiate acceptable payments condition. And once the order is placed, the commitment should be honoured. Any issue that arises in this area must be addressed effectively in order to sustain the goodwill. The ethical concern based on the issue faced is lack of morals by Aroma to the suppliers, as it always deferred the payment to suppliers until up to 3 years. Late payments for no valid or legitimate reason are unethical. The ethical principles underlying any contract is trust. And trust comes from fairness, honesty, and mutual benefit. A reputation for trustworthiness can provide sustainability competitive advantage. When Aroma abused the contract by late payment of invoices or changing the payment terms, trust is quickly broken. The delayed payments to the suppliers reflect the relationships and prevailing culture in the organizations. Furthermore, Aroma engages in financial statement in inflating activities, such as when Aroma acknowledged manipulating £277 million in earnings through aggressive accounting and profit recognition. Therefore, the solution is for Aroma should strategize the contract payments term properly. Monitoring contracts by payment terms will give Aroma a clear picture of what amount is expected to get debit and its impact on the cash flow. Aroma should choose the right account manager who has a good organizational skills. Therefore, Aroma can develop and maintain effective business relationships. Transparent and fair treatment of suppliers enhances the reputation and good standing of Aroma and the supply management. Alright, so the fourth and the last issue in Aroma is misrepresenting the accounting report for commercial income to conceal the poor financial position. This issue arose since the sales suddenly declined. The financial position of Aroma was in a bad state at the time. Therefore, it has decided to mask their financial position to appear more fine even though it does not. So since the payment of commercial income from the supplier is received earlier before the actual sales were made, it has overstayed the payment by recording the advance payment received as a profit. Besides, Aroma has also delayed the record of expense to make the financial condition of the company appear in a greater view than the actual condition. The alternative solution we found is that the management should raise this issue with the CEO and explain that they are not be able to move the transaction into the current financial year and delay the recording of expenses. When explaining the reason which the reporting cannot be produced, they could explain it in terms of risk to the company. This will help the CEO to understand the danger of misleading reporting. The second and the well-founded solution to the respective issue is to recognize the commercial income should be made as it is one of the sources of revenue. Plus, it is material to the account statement that the amount at the and the amount at the end of the year, as it is judgmental. It is because the amount affects the judgment of the users of the account statement, which is the shareholders of Aroma, which they expect to receive a high share price. The concern here is that Aroma is facing an ethical dilemma in financial reporting. This ethical concern was carried out in the intent of misleading investors and maintaining the company's share price under a great deal of pressure when the financial position of Aroma was in a bad state. Producing the misleading reports creates a major risk to the company, in which the company could face legal action if discovered. However, in this case, revelation of the accounting error made by the whistleblower results in the opening of investigation into whether Aroma had released the false and misleading statements. So the solution for this concern we have come up with is for Aroma to have a transparency for financial reporting, in which financial statements are true and reliable. Transparency helps decrease price volatility, since all users of financial information have the same data for making decisions. The more transparent financial reports become, the more investments company will receive and the higher their stock price will be. Investors need more transparent data about the monetary information of the organizations. An accountant should act within the framework of ethics and responsibilities, as well as professional knowledge and experience, and also resolve any dilemmas with professional ethics when confronted with any value judgment contradiction. So in conclusion, the accounting scandal that occurred in Aroma was because the poor corporate governance and the issue of aggressive accounting for commercial income. And also stakeholders and regulators play important role in curbing accounting scandal problems from happening. A bad relationship with the suppliers could lead to a bad reputation in the market and moving forwards. So that's all from us. Thank you.